Hi folks, Sanjana here. Today I am here with the important video, or I can say I am starting a series of videos on basics of stock market. If you start learning stock market randomly, you will spend years watching videos and still feel confused. Instead of that, think of stock market like you're pursuing MBBS. For that, first you need to understand the human body, right? In the similar way, first you need to understand the basics of stock market, financial concepts, how market and companies work before you invest in stocks or you enter the stock market. That is the motto behind these videos. So let's get started. Okay, let's start with the simple thing, company. Company is simply a legal structure created to do business. All of us know that, right? Think of a tea business. For that, first you need to buy tea powder, milk, sugar, and other raw materials. Then you sell tea and make profit. That's a simple business. When your business grows, you want to expand that business. You need more shops, more employees, more raw materials, and other things. For that, you need what? Money, right? How will you raise the money? Companies raise money mainly from two sources. One is debt and other one is equity. Debt is simply borrowing money. Let's say you take 10 lakh loan from bank. That's a debt. Equity is selling ownership. Instead of borrowing money from anyone or from bank, if a company says, give me money and I will give you a part of ownership. That ownership is called equity. I think you might have seen this in Shark Tank also. Next one is share. Share is a small piece of ownership in a company. Imagine you have a pizza, cut it into 10 slices. Each slice is equal to 1 share. If you own 1 share, that means you own 10% of the pizza, right? In the similar way, if a company has 1000 shares and you own 100 shares in it, that means you own 10% of the company. This is just an example to make you understand better. Next important term is IPO. IPO stands for Initial Public Offering. Imagine you have a company called XYZ Private Limited. Now you want to expand that business. For that, you need money, right? So how will you raise the money? You can't take money from public unless and until it goes for an IPO. So you have to convert your company from private limited to public limited. Only that time you can take money from public to grow your company. For that, you need to list your company in the stock exchange. In India, we have NSE and BSE, that is National Stock Exchange and Bombay Stock Exchange. I made a detailed video on IPO, types of IPO and how IPO works in a separate video. I'll give you that video link in the description. You can check that as well. Any individual who believes that the company could be profitable, invest in that company. That investment helps the company to grow and fund new initiative. When more and more people start investing in that company, the demand increases and the share price also increases and the market value of the company also increases. If for any reason the company seems to be less profitable, investors can sell their stocks. When more and more people sell their stocks, the demand decreases, the share price also decreases and the market value of the company also decreases. This may happen for many reasons. For example, changes in the leadership, new laws and trade policies, changes in the production technology, cost involved in it, labor cost and many other reasons. It's ultimately the human confidence to analyze a company and invest in it. It has a power to trigger everything from economic boom to financial crisis. That's why financial literacy is most important. In the next video, I'll cover revenue, types of profit and EBITDA. If you found this video helpful, please like the video and subscribe the channel and don't forget to comment below. See you in the next one.